Rubber stamping the deal. It's all about the contract. The contract literally is king within a property transaction. So administratively, the process of buying a home and securing finance, according to my wife this is intense, it's stressful, it's daunting, and it's traumatic. The last adjective actually makes me laugh out loud. Look, it can be all of these things, but it's never usually that bad. The contract is definitely king though, and it's absolutely imperative you understand the document prior to putting your autograph absolutely anywhere. Depending on where you live, different criteria will apply, but in all cases a contract requires agreement by both parties on an offer and an acceptance. Or you can be put off by the length and the complex terminology, which triggers a realization of the importance of the document, I guess. You should be well aware of the avenues to flex or renegotiate on the contract should something not completely sit right. On the flip side, the seller has very few contingencies to leverage should they wish to get out of the contract, which is comforting to know to a certain extent. So understanding the contract of sale, there's three different contracts. One would be a private treaty sale, two would be an auction, and three would be an off-the-plan purchase. The contract of sale is basically the terms and conditions. And look, the T's and C's are long and they have lots of sign here stickers. These are typically generally considered the identification marks. Other distinguishing factors include ambiguous terminology and, they can be used as sleeping aids. Boring, absolutely, but it's really important. So you've got to stick with this process and you've got to have a good conveyancer on your side that can help step you through each of these processes. So let's first off start looking at a private treaty sale. Now, if you're going to buy through an agent or a private seller, it's very well likely that you're entering into a private treaty sale. Now, the contract will be legally binding once it is signed by both parties and actually ensures that the property is not going to be sold to another higher bidder. Now, prior to signing, make sure you arrange for your solicitor or your conveyancer to advise you on the legal process and to look through the contract that you actually wish to sign. Once it's signed, you're entering into a treaty and a holding deposit will have to be paid. Now, this deposit is basically put down in good faith. Technically, you'll only need to put down $1. However, agents and vendors will essentially question your intentions should you do so. So real estate agents will also typically take their commission from this deposit, hence why they're going to be motivating you to provide additional funds. Now, this deposit will usually be held in a trust account by the real estate agent. Normally 5% should suffice. However, use your judgment in each scenario. Sometimes, say where the purchase price is around $550K, you could ask for a deposit of $2K when you make the offer, followed by an additional $25,000 when the house or the contract, becomes unconditional. Unconditional being once the finance and the building and pest inspection has been completed. Now, the essence of this contract is basically a checklist. Now, the checklist will cover off around about 7 or so main points, those being the address and the physical dimensions of the property. It'll also cover off the plan and the council reference numbers. It'll list the non-fixed items as well. It'll provide details around the settlement. It'll cover details around the inspection report, around easements and restrictions, and it'll also cover off the cooling off period. Now, most of those points are pretty self-explanatory, but I will go into detail on one of them, which is easements, because I'm always surprised that people tend to not know what an easement actually is. Now, an easement is basically a section of the property which allows someone the right to use the land for a special or a specific purpose, even if they don't own the land. Now, this could be a shared driveway, or it could be buried utilities like power lines or a phone or water lines, for example. And, easements can cause restrictions because the day that a tractor rolls into your backyard to dig up a busted water main, if the yard isn't already flooded, it's going to be a pretty sad one. So, easements can certainly be restricting, but they can also be great bargaining tools, but they do require a lot of careful consideration. Now, another style of contract that you'll enter into will be an auction. Now, we went into auctions in some detail during our adventure in our previous presentations, but you have to be mindful that the contract that you actually sign at an auction is going to be very different from a private treaty contract. The big differentiator is that these contracts are actually cash. They're a cash sale upon the fall of the hammer, and you're legally bound to exchange contracts and pay a deposit on the day. There's no cooling off period. Essentially, the contract is unconditional on the day. Building and pest inspections will need to be completed prior to the auction. If you're interested in the property and you intend to bid, get a contract from the agent before the auction and have your legal representative read through it. Seek advice on the terms and have unfavourable conditions deleted or altered. You have an entitlement to change clauses, and if your bid is good enough, the vendors are going to be flexible. Having the contract checked by your legal representative prior to the auction is imperative, in my opinion, and also arrange to have your finances pre-approved as well. Now, an off-the-plan contract of sale has similarities to a private treaty sale or a private treaty contract, but again, there's some big differences. So before signing, speak to a solicitor and make sure some of the following aspects are actually covered off. Make sure there's a cooling off period. Have details around the plan disclosures. Now, normally in a larger development, not all aspects will have final government or council approval. Also, have and ensure that the plans actually cover off the interior finishes as well. Before putting your signature anywhere, be absolutely certain you understand the plans and are actually comfortable with the level of disclosure. Be a devil for the detail in this aspect. As in the contract of sale, developers will always retain the right to alter the plans if required so they can finish off the job. So be mindful of that as well. Deposits. Now, up to 10% is going to be required, and usually it's going to be held in a trust until settlement. Check who will receive the interest if interest is actually accumulated by that trust. If the money is being earned, make sure that you try and get it, particularly if the development takes more than 12 months. That interest could actually be a substantial amount. Now, also have details around inclusions and warranties, and make sure that you're protected from overly favourable conditions to the builder, and also determine that you can make your own changes as well. Finance, it's important to make the contract subject to finance. It's very important, as the bank will undertake an evaluation on the completion of the property. Therefore, you have to ensure that the finished product basically aligns with what you're going to pay for it. Defects, do a pre-inspection and get any touch-ups completed before the settlement. And last point, on completion, timelines for completion will vary, and generally developers will want to have some flexibility around this. Now, if the developers cannot complete the property on time, consider cancelling the contract as long as you retain the deposit. Again, always seek legal advice, and be really cautious on the decisions that you actually make. You just want to ensure that it's favourable for you. Now, the golden rule when it comes to contracts that is, if it's not in writing and it hasn't been signed by either party, then the contract isn't enforceable. There's lots of things to get right. Most importantly, though, it's particularly important to get legal and professional advice on this to make sure that you're approaching things in the right manner. Usually, settlement for a property is about 4 to 6 weeks, but a shorter settlement can be as quick as 14 days or 21 days or even less sometimes. Settlements can also be a lot longer. They could be 60, 90, 120 days. Timelines, don't really matter. It just depends on what has actually been negotiated. Depends on what the buyer and the vendor are going to agree to. All in all, settlement times can vary considerably, but let's walk through a rough timeline of events to consider. So on the first day that you actually sign the contract, the contract is agreed, an initial deposit will need to be paid. And that depends on which state that you're actually living in. But generally, the deposit has to be paid that day. Now, secondly, you're going to have to engage a mortgage broker. You're going to have to engage someone like myself to commence actually seeking finance approval. Hence the importance of actually having pre-approval already administered. It can save a lot of heartache in the process to actually start searching for finance at this point in time. It can be pretty stressful when you've got a 2-week deadline and you're still trying at the very last minute to get finance approved. The next thing that you need to do on the day that you sign the contract is also engage a conveyancer and organise for building and pest inspection to be completed. And lastly, you need to get a cover note through your insurance provider on the property. Now, after about 7 days has passed, the building and pest inspection should be complete. The conveyancer will have also liaised regarding contract changes, and once amendments and inspections are complete and you've provided the deposit by cash or you've used a deposit bond, once the deposit is paid, the cooling off period is waived and the contract is locked in and binding to both parties. Now, after about 2 weeks or 14 days, the contract is binding and you'll know the settlement date and what stamp duty will need to be paid as well. Now, being a first home buyer, you'll also need to sign the required forms to obtain your first home owner's grant and stamp duty concession as well. Now, the bank and the conveyancer will obviously liaise around the valuation, and the mortgage broker will play a part in this as well to ensure that the contracts are exchanged appropriately and valuation is also complete. So the next thing will be the transfer of the title deeds and also for them to be lodged so the property can be listed under your own name. Now, after about 21 days, it's pretty likely that finance should be finalised and that cheques are very close to getting written. Now, it's time to start arranging for your utilities to be connected at settlement, along with redirecting your mail. Now, if you are in a strata arrangement, the body corporate manager will need to be contacted in order to finalise any outstanding levies and also to complete checks. After about 28 days, so 4 weeks, the finance should well and truly be approved and the conveyancer will liaise with the parties to ensure that the transfer of titles and finances are actually in place. And by about 35 days, you get the keys. You know, the contract has gone unconditional and it's ready for handover. It's finally yours. Get the bubbly out and have a celebratory drink. Congratulations. There are two options really when you go out and seek finance. One is to do it yourself directly and, go to banks, and the second is to work with a mortgage broker. Now, the mortgage industry is highly competitive and the majority of loans now are actually written through brokers compared to directly through a bank. Now, reasons will vary, but, I believe it's largely centered around choice. Some people want to shop around for themselves and, have a comparison and ensure they're getting the right deal. We're fortunate enough now to be a lot more educated about mortgage products and can also get access to, a pretty wide variety of information at next to no cost on most occasions to select something that's going to be right for you. The real benefit of using a mortgage broker like myself is that we're able to provide all of those choices under one roof, I guess, and give you the ability to access a wide range of lenders through panel arrangements that we have with banks. So we basically provide convenience and we take a lot of the legwork that's actually associated with sourcing finance. It can be a pretty administratively intense process going through a loan application. People will choose mortgage brokers like myself to act as that single point of contact and intermediary and to follow up on their behalf. So what do mortgage brokers actually do? Well, they're going to work with you as a client to basically determine your borrowing needs. They'll select a loan to suit and they're going to manage the loan process right the way through to settlement. Now, brokers can offer a variety of products through the panel arrangements that they have with lenders. which gives you a lot more choice than visiting one of the big retail banks, which could result in a more competitive deal for you. Now, brokers are basically going to be able to assist you in the selection and the management in the loan negotiation process as well as completing the legwork and offer advice to help you obtain the best deal that's going to be suitable to your requirements. Now, residential brokers are actually paid by the credit provider and receive an upfront commission and a trailing commission based on the size and the type of the loan. It's not standard practice for a broker to charge a client for their services due to this commission arrangement. Now, one of the benefits of using a broker is basically their ability to access their panel of lenders. These will range from large banks through to specialist non-lenders and also mortgage managers. Myself, I'm accredited with almost 24 different finance providers, for example. The size of the panel, though, will vary from broker to broker. Some will limit it and only exclusively work with a couple. Others will work with even more than a couple of dozen. It's competitive offerings out there, so you need to really shop around, and that's what mortgage brokers can do best by consolidating things in one house. So if you do meet with a mortgage broker, typically what the process would be to have an initial meeting and go through a fact-finding process, which is basically, a document that's used to collect information about you as a customer. So obtaining the appropriate information will basically assist in sourcing the most relevant loan product for you. So the information that they'll want to collect is, around the full names of each of the applicants, residential addresses and residential histories as well, marital status, your age, your contact details, details on dependents perhaps, and these are all necessary because of anti-money laundering legislation, and that information will be provided in order to verify your identity and for the process to continue. Think about having 100 points of ID, showing statements to evidence funds and where those funds have come from, pay slips and employment contracts and things like that. Occupation and your employment history, the status of it, whether it's part-time, full-time, or self-employed, your employer's details and the length of time that you've actually been employed will also need to be detailed and covered on. Your income, your salaries, the benefits and entitlements that you may receive. Other sources of income will also need to be detailed. The loan amount and the actual purpose of the loan will need to be provided, and a description will be necessary. And if you're self-employed, look, there's a whole string of other documentation that you're going to need to provide. Your business details, the name, the address, the contact details, the registered ABN, along with the type of business that's being performed, the size of the business, and the length of time that you've been in business. Also, with the property that's you've bought, you have to provide details around the address, the property type, the property size, facilities. There's a lot of detail that's been required, and finally, you're going to go into some detail around what your expenses are. What existing mortgages or personal loans or credit cards you may have. If you've got child support repayments, for example, or general living expenses, all are going to be factored in and will have an influence on your actual borrowing capacity. So once that necessary information is collected, the next step is to visit your credit history and go through the reporting agencies, and then put that together to make a recommendation and a structure on what's going to be most suited to your circumstances. The mortgage industry is highly regulated. Mortgage brokers should be members of a professional association such as the MFAA or the FBAA and hold the appropriate insurances. And members should also be participating in an external dispute resolution process, an ombudsman, for example. So myself, I'm an accredited member of the FBAA. I hold the relevant professional indemnity insurances, and I'm also a member of the Credit Investment Ombudsman as well, should a complaint actually arise. Now, outside of this, there's a number of regulatory bodies that also have a vested interest in banking and financial services industry, and they include ASIC and APRA and a number of others. And these are combined with, other professional bodies that have written rule books to ensure that basically the customer is protected. This is what it's all about. Now, for mortgage brokers that are doing business with you, they have to disclose the following things. This is mandatory. Firstly, they have to disclose a credit guide. Now, this provides you with basically the preliminary information about the mortgage broker. It also should provide some details discussing their limitations around their credit activities. Next should be a quote. Now, this document would be provided if they were going to charge an upfront fee for their services. The next thing that would have to be provided would be a proposal document. Now, this document basically sets out the costs of you using their services, including commissions that may be received. Now, this proposal document will generally be given at the same time as the service is being provided. Also, a written assessment. Now, this is a final assessment to outline their recommendations and state why it is suitable. Again, it should outline the fees and the charges of this product. So the big question that a lot of people ask is in relation to commissions and how much commission a mortgage broker is actually paid. Well, the best way to answer that is that it really just depends, because there's a lot of variables to take into consideration. So mortgage brokers are able to offer their services free of charge for their clients on the basis of this commission arrangement with banks. So how much will a mortgage broker actually receive from a bank? And it's hard to put concrete numbers around it because it will vary significantly from one lender to the next. Mortgage brokers will tend to work through an aggregator platform. Basically, an aggregator platform allows the brokers to have access and provide access to a wide range of lenders and different products. And for the use of this service, the brokers will have to pay a monthly fee and in most cases give a split or have a split on the commission as well with the aggregator. Again, this will vary depending on the aggregator platform and the volume of business that's actually written. That aside, a broker will receive a commission in two different formats when they sign you as new business. The first will be an upfront commission, which is generally the largest proportion. Now, this can range from 0.02% to 0.07%. That's probably at the higher end of what will be paid. So to put that into numbers, we'll look at that in a couple of slides ahead, but on most occasions, banks will probably pay at the lower end of that scale that I've just mentioned. Also, if the customer happens to default on the loan within a specified period, it's pretty likely that the broker will have to refund that commission as well. Now, the second aspect is the trail commission. Now, trail is basically the byproduct of the loan, and it's associated with a wide range of products, which also includes insurances and different styles of investments. Now, the trail figure will be paid on a monthly basis and could be paid for, for 5 years in some cases, or it could be paid for the life of the loan in others. Now, the average of a loan life these days is around about 5 years, give or take. Also, there's no certainty that trail will ever be paid, but typically this trail can range from about 0.02% to 0.03%, and generally again it's at the lower side of that range. So to ensure that you're actually getting the best deal, you need disclosure around this. You need to ensure that the agent is actually working within your best interests. So how much are they actually making? So let's say the loan is $400,000. The upfront commission that they're receiving is 0.07%, and the trail commission is 0.02%. So the upfront would basically equate to, almost $3,000. It would equate to $2,800, and the trail would be $800 per year, which is actually paid on a pro-rated basis, and will obviously reduce as the principal amount of the loan actually reduces as well. So that's how much a mortgage broker actually gets paid. And obviously the larger the loan value, the higher the upfront commission would be. But again, that does vary because some institutions will cap the commission that they pay. So it really just does depend. But you will also get disclosure on what the broker is receiving. Determining the serviceability is one of the major criteria that is actually going to be associated with your loan assessment. Serviceability is really about meeting the repayments and the affordability of doing so on a regular and long-term ongoing basis. So the factors that are going to be taken into account when assessing serviceability are going to include your monthly gross or net income, which would be derived from your salary or perhaps other sources that you have. It could be family payments from Centrelink or child support payments for that matter as well. Second of all, they're going to look at basic living expenses. And basic living expenses are typically calculated at around about 30 to 35% of your net salary. And that would increase depending on the number of dependents that you have. Also, you need to also look at the current level of your financial commitments, as that will influence the serviceability factor as well. And that would also include payments to existing loans, maintenance repayments, and also payments to credit cards as well. So basically what is left over from all of that is what can be used to service your monthly loan repayments. Now, there's individual peculiarities between each of these factors, and it's going to vary from lender to lender, but some general rules of thumb are that a steady income of at least 3 months with continuity thereafter is going to be required. Salary is assessed in full time, but overtime allowances and commissions may significantly be reduced or may not even be considered at all. Pensions are generally treated the same way as income. Family payments and child maintenance will vary depending on the lender. Rental income, if you've got an investment property, will usually be reduced by about a quarter. Other investment income could also be reduced as well. And expenses and how those expenses are treated will vary significantly between the lenders. Generally, they'll either apply a formula based on a percentage of income or use the Australian Bureau of Statistics table called the Henderson Poverty Index, which basically identifies the amount of monies that families of different sizes will need in order to make ends meet. Finally, financial commitments like those pesky credit cards or personal loans will also be taken into account. Generally, these will be looked at as a monthly cost and taken as a percentage of around about 3 to 5% of the actual credit limit. So they're the factors that will determine your ability from a bank's perspective to service your loan. Risk profiles. We all know that risk is basically the potential to lose something. And in the lending business, risk basically means losing money. It's important for a mortgage broker to establish your tolerance to risk, particularly when you're looking at an investment like a mortgage. Therefore, give some consideration to the acceptable level of risk that you'd be prepared to actually take. Is it low, moderate, or high? Think about your timescales. And depending on where you sit will also depend on your flexibility that you'll actually require for a mortgage product. Generally, the more flexibility you'll require in a product, the more expensive that product will be. But being that, But being on that side, it could really well be worth a whole lot more than those costs if your attitudes and circumstances do change. Say, for example, you started a family. It could be a great benefit to have a break from your ongoing mortgage repayments to deal with the additional expenses of having that child in the family. There's some of the factors that should be discussed with your mortgage broker and taken into consideration, which will obviously evolve around your changing needs and circumstances, and then in turn reflect back into your risk profile as well.